It's kind of wild how a single event, happening thousands of miles away, can just send these massive shockwaves through the entire global economy. It's like one domino falls, and suddenly everything, your gas prices, your investments, the cost of just about everything, gets caught in this massive chain reaction. So, okay, let's dive right into this domino effect, starting with the one number that has everyone on edge.
$120. That's the peak price a barrel of Brent crude oil just hit. Now, this isn't just some number for traders on a screen. No. This is the epicenter of a huge energy shock that's now radiating out across the entire globe. And it all started with one single critical flashpoint.
So let's talk about that first domino to fall. It all starts with a geopolitical flashpoint, a regional conflict that, almost overnight, became a massive problem for the whole world's economy.
And the escalation was just incredibly fast. I mean, look at this timeline. It all kicks off on February 28th with strikes on Iran. And immediately, you see energy prices spike sharply in early March. By the middle of the month, this wasn't just about market jitters anymore. We were seeing real, tangible, major disruptions in the global supply chain.
Now, you might be asking, why does this one regional event have such a massive global impact? Well, it really just comes down to geography. The conflict is happening right on top of one of the most vital arteries for all of global trade, and it's threatening the flow of the world's energy supply.
And to put a number on it, check this out, 20%. A full fifth of all the world's oil. Yeah, that Brent crude benchmark you always hear about, plus a huge amount of its liquefied natural gas for power and heating, all of it flows through this one single choke point, the Strait of Hormuz. So with that vital artery now under threat, well, the second domino is pretty much guaranteed to fall.
And that threat to the energy supply brings us to our second section, the energy shockwave. This is where we see how that geopolitical crisis turned into a full-blown energy crisis, with consequences that hit all of us right away.
And this right here, this is where it really starts to hit home for pretty much everybody. In the US alone, the average price for a gallon of gas just shot up from around $2.92 last month to $3.84 this month. It's a really painful reminder of how connected we are to these global supply chains, but honestly, it's just the tip of the iceberg. You see, the problem is spreading way beyond that one shipping lane. Iraq has had to declare what's called force majeure, which is basically a legal way of saying they have to stop their oil operations. You've got drone strikes hitting refineries in Kuwait. And out at sea, there are more than 150 of these massive oil and gas carriers just stuck, unable to move. The disruption is even rippling out into industries that seem totally unrelated, like fertilizer and the helium you need for semiconductors. All this chaos creates a huge problem for the people trying to manage the economy.
So this energy shock has pushed the world's central banks into what is, frankly, an almost impossible position. It's a classic policymaker's nightmare.
This just lays out the bind they're in perfectly. They are truly stuck between a rock and a hard place. Okay, option one, they could hike interest rates to fight this new wave of inflation. But the risk? They could easily tip their economies into a full-blown recession. So option two, they could cut rates to try and help economic growth. But that would just pour more fuel on the inflationary fire. There are just no good options on the table.
And you can see the real-world results of this dilemma right here in the Eurozone's latest forecast. The European Central Bank, which manages the economy for all the countries using the euro, they had to slash their growth forecast way down to just 0.9%. And at the same time, they had to raise their inflation forecast up to 2.6%. That's well above their target. It's the literal definition of a policy nightmare. Growth is going down, prices are going up.
So, what do you do when every single choice you have is a bad one? Well, you do nothing. The US Federal Reserve, Europe's ECB, the Bank of England, the Bank of Japan, all the big players have basically just hit pause. They're holding rates steady. It's what people are calling a synchronized hold, but all this inaction just adds another layer of uncertainty to the mix, which, as you know, financial markets absolutely hate.
And all of this brings us right to our fourth section, where we see that next domino fall. The markets are sounding the alarm. So let's take a look at how they're reacting to this crazy cocktail of geopolitical risk, rising inflation, and total policy uncertainty.
4. That's the number of weeks in a row that major stock indices have been losing value. It is the longest losing streak we've seen in over a year, and it really shows this deepening anxiety among investors. They're quickly adjusting their portfolios for a world that suddenly seems way more volatile, and that usually means pulling money out of stocks and putting it into safer things like government bonds.
And the pain is being felt pretty much across the board. In just one recent week, the Dow,
The S&P 500, the Nasdaq, they all saw pretty big losses. Investors are selling because that hope they had for interest rate cuts later this year, yeah, that's basically evaporated. With the central banks frozen, that cheap money that's been fueling market growth for a while now, it's just not a sure thing anymore. And that is making investors extremely nervous. Now, this sell-off is pushing some markets into what's known as correction territory. You're going to hear this term a lot, so what does it actually mean? It's simple. It's when a stock market index falls 10% or more from its most recent high. It's a technical term, but it's basically a big flashing sign that says investor concern is getting serious.
So here's the really crucial point. The Russell 2000, which is the index that tracks smaller companies in the US, has now officially entered a correction. And this is a really big deal, because trouble for these smaller companies can often be an early warning sign of broader economic stress, stuff that goes way beyond just Wall Street.
Okay, so for our final section, let's zoom all the way out. You line up all these falling dominoes: the geopolitical crisis, the energy shock, the paralyzed central banks, and the spooked markets, and they are all pointing toward one big overarching economic threat: the specter of stagflation.
And that huge threat is stagflation. It's a word you might have heard, and it's this really toxic combination of economic stagnation, which means slow or no growth, happening at the exact same time as high inflation. It's the worst of both worlds, and it's without a doubt the #1 fear gripping the global economy right now.
But it is really important to add some context here. While the risk is very, very real, the Federal Reserve Chair Jerome Powell has said that we aren't seeing true 1970s-style stagflation, at least not yet. The thing is, all the ingredients are definitely there.
And to really get a handle on the stagnation part of that risk, just look at this number. Even before this whole crisis hit, U.S. economic growth in the last quarter of 2025 was a pretty weak 0.7%. So the economy was already slowing down. Now, just imagine pouring a massive energy price shock right on top of that already weak foundation. And that leaves us with the final, critical question, the multi-trillion-dollar question, really. With economic growth already sputtering and a new wave of inflation coming in hot, have the world's central banks run out of moves? Are they trapped, forced to choose between causing a recession and letting prices run wild? That is the dilemma right at the heart of this entire crisis.